Welcome back. Hope you're having a good morning. Well, the SGX Nifty, the last time I checked, was suggesting that we'd like to pull back a little bit, maybe 20 to around 30 points lower. That's par for the course, one would say, because if that happens, it gives you an entry opportunity. And we know buying on dips has worked. But a lot of stocks to discuss. So let's get in Deepan Mehta, Director at Elixir Equities, who joins us. Hi, Deepan. Morning. Thanks so much for joining in. Well, let's talk about Bajaj Finance. Came out with its set of numbers. Valuation-wise, not cheap, but one of those go-to stocks, right? What's your view on the stock at current reckoning?
Yeah, good morning, Nigel, and thank you for having me on your show. See, at least one can say that if the valuations are rich, then they are justified with the kind of numbers that the company has declared on that kind of a base to grow the business the way it has and deliver best-in-class growth rates with such low levels of NPAs and the highest standards of corporate governance and risk management. So what is missing in Bajaj Finance? Absolutely nothing. So I guess the high multiples are justified. And maybe, there may be better opportunities in the banking NBFC space now that the entire sector is doing well. But Bajaj Finance is like a core holding. You just, if you're invested in it, you remain invested and it continues to compound its earnings. And at some point of time, the compression in P multiple price to book will stabilize, and then you will see the stock going up in line with its earnings growth, which anyway can be expected to be around 20% on a very long term, on a very longer time frame, even 5-10 years or so. So generally positive on Bajaj Finance, but as I said, I think there may be better opportunities in the NBFC space, which may give a higher return.
Deepan, hi. Good morning, Surabhi here. Like which ones?
Well, see, I think some of the smaller players will be, they are going to grow at a much faster clip. We saw numbers coming from Poonawalla Finance. Those were very, very impressive. And under new management and the fact that they have the Poonawalla brand, they'll be able to raise resources also far more easily and at attractive rates. That's one interesting stock which comes to mind in the NBFC space. We haven't seen the numbers from the microfinance companies like Credit Access. And so I think those also may deliver exceptionally good numbers. Then there are some mid-cap banks like IDFC First Bank, Federal Bank, I think, which can grow at a much faster pace. And the risk return profile for these small mid-cap companies is far better than the larger ones like the Bajaj Finances and maybe some of the other larger banks as well. Another company which comes to mind is MAS, Mass Financial Services. It's interesting NBFC. And there are many such interesting small NBFC stroke banks which can grow at 30-40% also now that the environment is much better for them. And credit costs have not gone up. So a lot of the net interest income increases will flow into the bottom line.
Got that. What about the sort of mid-cap tech companies? Let's take Coforge as an example. Growth is better than expectations, though there is a bit of a margin miss. What happens to the stock in your opinion? I mean, L&T Tech, of course, reported earlier. If you have any thoughts on that as well.
See, Prashant, in the IT space, small is beautiful now. And it's been like that for quite some time. In the last 25-30 years that I've been tracking IT stocks, it's the first time I've seen that for such extended period of time, mid-cap IT has performed better, not only in terms of financial performance, but also stock price performance. And they're quoting at a premium to large-cap IT. And the reason for that is the maturity of the industry and as well as strategies adopted by mid-cap IT companies. So companies like Coforge would have been very aggressive in terms of marketing, in terms of positioning themselves in specific verticals with specific talent and skill set. They have been able to still deliver the growth rate despite there being a crunch as far as tech spending is concerned. And it seems quite apparent now that the tech spending is going to impact the large cap IT much more. Of course, base effect is the real issue behind it. But mid cap IT, because of their various niches, I think is able to generally generate that 15 to 20% type of top line growth. And I think Coforge, with the number that it has declared, at least, it will sustain these kind of earnings multiple and still continue to deliver decent returns over the medium to long term. And we need to get more and more selective when it comes to software because there will be a few mid-cap IT companies which may not do as well. But there are at least a bunch of 4 or 5 high-profile, high-growth mid-cap IT companies which will continue to deliver superior returns, and that's what we need to focus on.
All right, Deepan, stay on. In fact, since we're on the subject, let's actually talk to a mid-cap or tier 2 IT company management. We'll come back to you with more questions. The company in focus is L&T Tech, which came out with a better than expected set of numbers for the quarter gone by. The revenue was actually slightly higher than estimates, but the margin was down about 50 basis